Hi, it's Rich here. This video is about what I consider to be the most important relationship in your financials and when you're running your business to ensuring that you have a grasp of whether your business is profitable, has a sustainable chance at profitability, and the relationship between these three factors are easily manipulated to ensure success. So it starts with cash. So it's your initial investment, maybe a bank loan, maybe it's money from friends or family, but it starts with cash. And cash gets turned into inventory. So it all stays on the same side of the balance sheet. It's on the asset side of the balance sheet. So the cash gets turned into inventory or products that you were going to sell. Inventory then becomes, when you sell it, either cash if you're selling it across the counter and your customers are paying you right up front, or it becomes a receivable. So that circle, triangle, cash, inventory, receivable, you get paid, becomes cash, inventory, receivable, you get paid. That is where the money is made. If that circle or triangle does not generate enough profit to carry the rest of your expenses, your rent, your labor, your general and admin office costs, your paper, your copier, like all those other things that make your business run, if that churn of money on the asset side does not generate enough profit to pay for those other expenses that you know are there, you got a tough business to make profit. So there are many ways of ensuring that you increase profitability in that churn of funds. You can increase your prices, you can reduce the cost of your inventory. You got to make sure you get paid, so your receivables, you've got to stay on top of that. So make sure your customers pay you. All of those things, but think about it, you've got only three factors to focus on. And this, to me, is the most important relationship in all the financials we'll discuss later on. Cash becomes inventory, becomes receivables, becomes cash, becomes inventory, becomes receivables. And the number of churn cycles that happen determine whether you're going to make money or not. So I'm going to leave it at that. It's a really simple concept, but it's important. I like when you grasp a concept, you can close your eyes and you can see that little relationship. Cash, inventory, receivables, and it all stays on the asset side of the balance sheet. It's not a liability. It's not. That excess cash you can turn into, maybe we're going to grow our inventory. Maybe the excess cash is actually funding the receivables, and your receivables are growing, so you're actually funding your customers. That's not good. Just make sure you understand that the profit you're reinvesting in your business in that churn, and that the excess money becomes your profit. Short video. Hopefully it's helpful. We're going to move on, obviously, but I think this is the most important relationship that you need to grasp, is that really, really tight churn of how you make money. Thanks.